Well, that auction coming up at the top of the hour. Joining us now for more on Treasuries and what to expect in the auction of 10 years. Today's James Caron, Morgan Stanley's global head of interest rate strategy. So you put out a forecast, James. First, welcome to you. And you're looking for what amounts to maybe a violent correction in the 10-year with one of the most bearish forecasts for rates out there. You're looking for the 10-year to yield like 4.5% by the middle of next year. Why?
Well, I think we have to look at this from the initial conditions in the marketplace. So we're coming from a very, very low, abnormally low level of yields. And if we think about why we're here, which is that we've seen a lot of money flow into bonds in the fourth quarter and even in the third quarter, that we have a very overcrowded position. And whenever you have an overcrowded position, there's a lot of vulnerability for a correction. So then we can think about it next in terms of then what would be the catalyst for change. The catalyst for change could just be that we have an asset allocation decision that says that, look, bonds have had a great year. I mean, corporate bonds this year are up about 20% year to date. What if we start to allocate a little bit away from that? And then what we find is that there's a large degree of sensitivity to rising interest rates across many asset classes right now. And for example, corporates at this point are, even though spreads aren't necessarily historically low, the level of interest rates on these corporate bonds are very, very low. So that means if rates start to rise, that the negative returns that can be achieved in credit could happen very, very quickly, and it may catalyze a fair amount of selling. And I think that sensitivity to rates becomes the accelerant where we can actually push rates a lot higher. Selling begets selling. The equity market, people with equity market exposure to rates also need to sell. And then the traditional mortgage-backed security market with negative convexity selling needs would also have to come in and sell and hedge. All this together, to me, creates a situation where 10-year yields can get to 4.5% by the middle of next year, and the yield curve can steepen out to 325 basis points, possibly 350.
Hey, Jim, this is Brian. Luke, let me ask you a question. You know, everybody's concerned, or a lot of people are concerned about the deflationary argument. What's the #1 reason why we won't have deflation next year?
Well, first, I'll have to say that there's a lot of money sloshing around in the system right now, and the Fed has acted very proactively. The government's acted very, very proactively to keep this liquidity in the marketplace. I don't know if we're going to be able to withdraw liquidity as fast as advertised. And the result of that is that I think that there's still going to be a fair amount of inflation risk premiums. Money supply is still very high. If we get economic activity starting to go, which it seems to be pointed in the right direction right now, the economy does seem to be improving. If we get velocity of money starting to change, the money supply times the velocity, to me, is going to spell some inflationary pressures going forward.
And then another question, you talk a lot about the steepness, meaning more sell-off in the long and the 30 years, that steepness in the yield curve. Is that going to really what we're seeing right now is the steepest levels we've seen in maybe 15 years. How is that going to get out of that long-term range?
Yeah, well, what's different today is that, number one, we're issuing a fair amount of bonds. We're also in a recovery period, and we're issuing $2.6 trillion of gross Treasury supply in 2010. That's unprecedented. So the fact that we can get to an unprecedented steepness in the yield curve is not so unprecedented when we recognize that there's a lot of different factors at work here that are very, very different than in the past. Typically, every time the curve has gotten to these levels, it's flattened a lot. This time, though, I think it's different. I think a lot of the differences has to do with the amount of money supply that's out there, the inflation risk premiums, and also the amount of bond supply that's coming, plus the extension of duration of the maturity of the debt is also extending, not only in the public sector, but in the private sector. So to me, that tells me that there's going to be more risk for steeper curves as opposed to flatter curves, at least at this point in the cycle.
Can you think of any other period where the Fed has had so much influence both on long and short-term rates?
No, not on long and short-term rates. I mean, in short-term rates, for sure. The Fed always has a lot of control over short-term rates. But long-end rates, what's very, very different now is that the Fed does have a fair amount of control over long-term rates, just in the sense of all the market support facilities out there and the liquidity facilities. Many of these support facilities are there to support bonds of longer maturity, of other asset classes, of credit and what have you.
Right.
So the fact that if we remove those support facilities, that may actually increase rates on the back end. That's what's unprecedented this time.
James, are tips going to be spared in this sell-off, or is this going to be an inflation-driven sell-off?
No, I don't think it's an inflation-driven sell-off.
Why not?
Well, because essentially we still have a fair output gap. I think the unemployment rate's going to stay, relatively high. So essentially, I don't think that inflation is going to really rise beyond 1 to 2%. To me, it's more about inflation expectations. So I don't think that we see inflation rising beyond 2% in 2010. So it's more about nominal yields rising and break-even spreads widening, not so much about not so much about an inflation-driven move to higher rates.
And I believe our Brian Luke has one more question for you, James.
Yeah, Jim, I want to talk about the regulatory environment you talk about. One of the big concerns is, how do you become a political analyst versus a debt analyst?
Well, that's a challenge. It changes every day. I think the regulatory environment going forward is going to be somewhat of a headwind, particularly as we get through the middle part of the year and we get into the midterm elections, and we probably start talking more about fiscal restraint as opposed to fiscal stimulus. We're seeing that happen in the UK right now, and today's news about the regulations and taxations on bonuses and things like that is a perfect example of that.
Right.
So it is very, very difficult, but I think the second half of the year may feel some headwinds on the fiscal front and on the political front.
Yeah.
But so far for the first half of the year, I think that the risk-reward balance is tilted towards higher rates.
James Caron of Morgan Stanley joining us this afternoon. James, as always, thanks so much.